Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. With me is Chase Wilsey. Chase, how you doing?
Good to be here.
We got some big things today going on outside of the office. We'll save that for a little bit. Actually, just mention real quick and talk more about it. But you got the golf tournament today. I got the car show today, the charity car show down in Embarcadero. But let's talk about something that's on everyone's mind, and that is the inflation. And the highly anticipated inflation numbers came out this past week for July, and better than expected. I've kind of talked about this, but July inflation was 8.5%, a decline from June's inflation numbers of 9.1%, and also very important, below the forecast of 8.7%. Now, 1 month does not make a trend. However, I believe this could be the start of the decline to December 31st. Couple reasons. I think that we have continued to post about different commodities and how their prices have come down, and it would take some time to get through to the consumer.
And I believe we're starting to see the benefit of those declining commodity prices, and also to the supply chains at this time. Well, they will not kind of drop and continue to have the same problems that we're seeing. They're either going to stabilize or we're going to start to see increased supply. And I think that's going to continue to rise faster than demand. And also, too, I believe the consumer will not go back to the high spending. They are still feeling the effects of the higher prices and will continue to reduce where they can. And the other thing, too, I've also mentioned in the past about the higher base number for inflation, which would make year-over-year inflation numbers lower. We'll have to stay tuned, and we'll have to continue to watch inflation closely here. But again, just as a reminder, so this year we're seeing this 9% inflation. Well, when we hit March of 2023, that sounds weird to say, but if we had another 9%, that's a huge increase. Yep. I don't foresee that happening because you're already lapping such a high base there.
Right, and we have the consumer kind of pulling back already. And we have talked in the past about how we expect inflation will ease as commodity prices decline, and we're now seeing that unravel as hedge funds have continued to drop the contracts, bringing prices way down for soybeans, wheat, and corn. The biggest decline was seen in wheat, which is down 27% over the past 3 months. Corn has fallen by 24% over the same time period. Soybean down 14%.
And we keep talking about this as well, but it's not going to be reflected tomorrow. It takes time for these cost changes to work their way through the supply chain. It was the same thing on the way up, where the companies had to kind of pass it on, and that's why you're still seeing it kind of lag somewhat, and it's going to be the same thing on the way down. And also, too, got to point out here, if we have a difficult harvest this summer and Ukraine exports of wheat stop again, this could turn around and go back up very, very quickly. We've seen how volatile these commodity prices can be, so we'll again have to continue to watch these numbers as well for inflation.
Yeah, and there's things coming up. I mean, we're in hurricane season. That can disrupt things. So there's a lot of things going on. I guess the Midwest is having a pretty heavy heat wave there, and this is what we do. We stay on top of this, and I always try to promote the newsletter at the end. But if you want to keep abreast of what's going on, we see changes. We will always put them on our newsletter. We'll do them on the post. I'll just promote it now. The newsletter is on our website, smartinvesting2000.com, and we will keep you up on that situation, and many other situations as well. But it's just so important to watch what's happening at the very beginning. And we're not saying, inflation is going away. It is not going away. But what we were saying, what people were like, it's going to go to 12, 15, 16%. Like, no, because we're watching the commodities. Oil has come down as well. There's other things have come down. So it all comes together. And we're not going to be at zero inflation by December 31st. But we have talked about that by the end of the year. We could be somewhere around 5, maybe 6% or so.
Yeah, and the other thing I wanted to talk about, too, is the PPI. And that came out this past week as well. That's the Producer Price Index. And I'm very keen on this number here, because this is, again, what businesses are paying. And I have this conversation all the time, but businesses aren't stupid. They don't just take the higher cost and be like, oh, well, that sucks. So this, to me, is many times a leading indicator for what's going to happen for CPI. And I thought it was very, very strange how the market was so excited about PPI when it came out on Thursday. Reason for that is it showed a decline month over month of 0.5% when the estimate was a gain of 0.2%. Everybody's like, oh, this is great news. Well, you look at year over year, it was up 9.8%.
Yeah.
And yes, that's down from the peak of 11.7% in March and also June's increase of 11.3%. But you're decelerating from such a high level that it's almost just natural that it's going to come down. You can't just have 11% on top of 11%. That's extremely unlikely. And I really think that the market right now, especially these high growth names that we keep talking about, is discounting the Federal Reserve. I think they're thinking they're going to pull back here. But at 9.8% PPI, there's no reason for them to take the foot off the brakes there.
Yeah. Foot off the brakes?
Foot off the gas. I'm sorry.
Yeah, okay, right.
I was just all fired up about it.
I know. But it's true. And that's one thing, like, oh, they're not going to increase. They will increase. Maybe there'll be no talk about a 1% increase. Maybe not even a 3/4, but I'd say at least a half, because, again, we still don't have, and their target, remember their target is what, 2 to 3%, I think is a target.
Inflation, yeah.
And so we're way off that level. Now, I don't want them to go too quickly because they could force the recession worse. And again, mathematically, we're in a recession, but we still have a great jobs market, so people are doing okay because they have a job and can get another job if they lose their job. So, but it's important to watch this stuff closely, and it also, and again, we talk about investing in businesses and so forth. You got to see how it's going to affect the businesses, because we know if that inflation does continue to rise, people won't buy stuff, and it's just, you got to watch this stuff where it starts in the beginning. It takes a lot of time. People will wonder what we do with our time all the time.
Yeah, and I think you got to really be careful, as we kind of said, because it comes September. I believe that's the next Fed meeting. Is right now it's about a 50-50 chance for a 0.5% increase or a 0.75% increase.
Right.
Well, we're going to get retail sales before then. I believe we'll get another CPI report perhaps in September. I don't know the exact date of the meeting. But if you have a surprise to the upside, all of a sudden the chances increase to 0.75%. That's where you're going to see, again, the NASDAQ and the high growth names, I think, really take it on the chin. So you got to be careful here. I think that inflation just decelerating is not enough of a story to have a lower concern of rising interest rates.
Yeah, and
long term.
Right, and I was thinking the same thing you are. I believe we get another CPI, PPI report before the Fed meets again, which would be helpful. But even if it goes from 8% down to 7.5%, they still got to keep tightening, because that's still too high. And that could be a negative. And I'm talking about when I talk to our clients and so forth, that we do see our portfolio ending up very well for the year. But I think there still could be one more little hiccup here. We've had a nice last couple of weeks here. Be prepared, I believe, for another slight downturn. I don't think we're going back down to the June levels, but it's not like, clear ceiling from here to December 31st.
Yeah.
So let's talk about things that we talk about on our radio show, our podcast, the Smart Investing Show, all these things we talk about. One of the things we talk about, and when we go through the valuation numbers, we talk about, we cover the valuation price is price to tangible book value, which backs out intangible assets. Now, when the economy slows down and markets decline, this is when investors can begin to see intangible asset write-downs. Now, currently, intangible assets are now count for about 30% of the total assets of the 500 largest U.S. companies, which does not include banks and real estate firms. Compare that to 10 years ago when it was only 5%. Now, with higher interest rates, lower growth projections, and lower stock prices, this can cause some companies to do what's called an impairment of assets and write down all or some of the intangible assets.
Yeah, and that's an accounting metric that is done, I believe, once a year by the firm. So definitely something you got to keep an eye on. And some analysts and others say it doesn't matter because they are non-cash write-downs. We choose to be more conservative and say that these intangible assets represent cash paid at the time of the purchase. And had the company not overpaid for the asset, they would still have that cash on a balance sheet. It is also apparent that companies that are forced to write down their intangible assets tend to underperform the market for years after the impairment. This is why at our firm, Wilsey Asset Management, for well over the last 20 years, when we are investing, we always look at what the intangible assets are during good times and bad times. And this is why when we go through difficult times like now, we know we have strong companies that can weather these difficult periods.
And the reason why we do that is people coming in now saying, well, I'm concerned, I'm conservative. Well, we bought businesses that, 12, 24, 36 months ago that we looked at the intangible assets. Now, it doesn't mean they won't have some write down, but they'll not have the major write down, because we do look at that to make sure. And you're always looking at, even during great times, you don't want to throw caution to the wind, because you never know when, difficult times will happen. And this is one that a lot of people don't look about. They don't even know what it's about. But the intangible assets on a balance sheet can really destroy it. And who was it? Wasn't it AOL had
AOL Time Warner
$100 billion write down?
That was back in like 2000, so $100 billion. That's a lot of money.
Yeah, and when we do it, we always look at the price to tangible book value, and just kind of help our listeners out here. We compare it to the industry, and a lower number is better. Because a higher number means a lot of intangible assets on the balance sheet. You can then go to the balance sheet and look at it and say, ooh, there could be a risk here. And you said once a year. I know they have to test maybe once a year, or perhaps if they see something that looks like this is a problem, we need to test it.
Yeah, because one of the key ones too is goodwill. And goodwill is when you acquire a company over the book value of that business, the difference is goodwill. And the reason this is so important is because a lot of times when companies are buying different businesses, well, you're looking at, well, what are the future cash flows of that business going to be? What are the potential synergy savings? And all of a sudden, if that doesn't pan out the same way, there is going to be a penalty in the market, because you had anticipated that purchase was going to be more beneficial than it has panned out to be. Another thing to look at here too is, I was thinking while we were talking, it's like being an investor. And you invest in a company and it goes down 40%, 50%. Like, well, if I don't sell it, it's not that bad. I haven't taken a loss yet. It's the opportunity cost.
Yeah.
If you would have bought a different business, or you would have invested that in maybe a new plant or new capital expenditures or whatever it may have been, it would have been a better investment. So, hindsight's always 20/20. It's very difficult to run a business. Things like that are going to happen, but you still need to make sure as an investor you're being very cognizant of things like this. And we do invest in companies that have intangible assets, but one thing you want to look at is like the return on assets. You want to make sure that's still strong. You want to look at as well that many times it could have been purchases many, many years ago. Well, how have those synergies and those cash flows planned out for that particular business, and where do those brands stand now?
And I'm not sure on some of what we call the high flyers. I don't think they have that bad of intangible assets in the balance sheet, but they could. And I mean, maybe somebody call them about Amazon or Apple or Tesla. I don't think they're in that trouble, but you never know. I mean, I know they have bought companies over time, so it could be, and it's just something you should look at, because it could come out of left field and so
Not ready for it.
No, yeah, be ready for it. Well, let's talk about the population. The current world population is 7.96 billion people, and it's projected by the year 2050, which is now only about 27 years away. It sounds like 2050 is so far away. It's really not 27 years. The population will grow to 9.7 billion people. The question is, how will we feed all these people? It is very interesting to note how farming, more than ever, needs to be extremely productive. There are companies now that are using drones, robotics, navigation systems, and extensive use of data and analytics to make farmers more productive.
Some companies making headway in this industry as well will look at potential good long-term investments include Deere and CNH Industrial. This may also be one of those investments that make you feel good because you're doing something to help feed the world and yet making money on your investment at the same time. Please note that this could be a very long-term investment, and we have not done necessarily the fundamental analysis on these companies, but I know I looked at Deere, gosh, I think it was at the beginning of the year, and I like the business because there's actually a good article in Barron's, I think maybe it was last year, talking about this and the strides that they're making, and the big difference that benefits them more than their current type of product mix is more service-based. So you get more reoccurring revenue. So it could justify a higher multiple because you're not going to have the same cyclicality that you do with the ups and the downs and the investment cycles of different companies. So it's it's definitely an interesting investment thesis, but of course the numbers always have to make sense. And unfortunately, we looked at Deere, it was just a little too expensive.
A little too expensive. And one thing that I did notice change in the industry, and actually it's happening in software where you pay service fees. You don't pay for the product, you pay service fees. There appears to be, that's the direction that farming could be going, is that these farmers and producers, they actually pay Deere and CNH service fees, which will help smooth out their income, which again makes people feel better because that income's coming in, you need it, and so forth. It can raise prices a little bit, but yeah, it's definitely changing. It's something I would like to get into, but as I said, they're just a little bit expensive, so we need for things to drop a little bit before we buy them. But it's just interesting area.
You know, I was just kind of sitting here thinking as well as I wonder if like Caterpillar, they're not in the agriculture as much.
They're more
as,
construction.
Yeah. But if they're looking at ways, because it seems like more and more businesses are trying to go toward, it's like the SaaS, the software as a service.
Yeah.
You know, more and more companies are trying to get that reoccurring subscription revenue. You know, even like General Motors and I think even Ford as well is trying to look at ways to continually make money off their customers after they sell their vehicles. I wonder if these other companies like Caterpillar, it just comes to mind, is also looking at ways that they can kind of change their businesses to make them a little bit safer with that type of reoccurring revenue.
It also helps the business consumer, I'll call it, because then you'll have that big outlay of cash for either the software or whatever the product may be. It'll smooth out their expenses to match the income coming in. So it's kind of a nice thing for the business buying that software or buying that, we'll say, drone service or whatever it may be, because your income will match up with the expenses as opposed to taking one big hit of $1 billion with new equipment.
It is interesting just kind of see how businesses change over time. And one thing I was thinking about was when I was in college, we learned about just-in-time inventory.
Yes.
And they were talking about how during COVID, just-in-time inventory was dead because the supply chains got all messed up. And I'm like, I think that's just like, you don't want to have too much inventory there,
right,
because now you're starting to see companies that have to discount that inventory. So that's why like just-in-time inventory always made sense to me. And now it seems like that subscription type model has really expanded itself into different business practices as well. It's just a kind of a fascinating thing to read about and learn about and see how business leaders kind of try and change the environment there.
And if you like the topics we just talked about, other topics on our newsletter as well, talk about what's going on in Las Vegas, the railroads, the employment numbers, free newsletter at our website. Go to the website address, smartinvesting2000.com. smartinvesting2000.com. When you go to the website, you'll see newsletter pretty much right in the middle by podcast, everything else there, and it's free. And we get a lot of compliments on that. People say it's really very informative. I really like reading it. And the other thing you and I were talking about walking the door, it's not 5 or 6 pages. You can read it in a short time, get a lot of information quickly, because who has time to read a 5-page newsletter?
And how many people?
No, not many, not these days. So before, let's open the phone lines here, 833-288-0973. Again, as always, I'll open the phone lines for your unbiased, no strings attached, fundamental opinion about what you want to talk about. And again, you got investments you're looking at doing. You're looking at buying some equities. You're not sure if it's a good time to buy or not. We'll go over all the fundamentals for you. Try to point in the right direction as far as what's going on. I just want to talk about the economy or general things on investing. We're here for that as well. Again, phone number 833-288-0973. 833-288-0973. Well, Chase, after the show, both you and I got to run out here quickly. You're running up to your golf tournament for the Fighters Fight Foundation. That is your foundation.
Yeah, no, super excited about it. Talked about it a couple times on the radio show, but really great turnout. I mean, we have our Tarco stand coming. We got, Ale Smith actually donated some of their hazy IPAs.
That's a great restaurant to go to. We got to go back. We've not been there in a while. We need to go back to Ale Smith.
Brewery, but yeah, they have the food trucks out back too. And then, just some great businesses around town donated for the silent auction. We got, Saquon made a nice donation, and Duke's down in La Jolla, they made a very generous gift card donation, and then Yanni's, one of our favorite restaurants. So we have some great prizes, some great silent auction items. I mean, I think it's going to be a great event. And the big thing is it all goes towards charity and my charity. And no, I don't take a salary or anything from it. Nobody from my charity takes a salary. It's all volunteer based, and all the money is going to go back to women that are fighting breast cancer and making sure they can kind of enjoy some experiences and spend time with their family and friends, just because it's such a chaotic lifestyle when you're going through those treatments and stuff. So super excited about it. Our registrations were up about 50% from last year in year two, so that's phenomenal. Next year, definitely want to kind of close out that whole tournament style and make sure we lock it in. So it's going to be an annual thing. So if you missed it this year, hopefully you can join us next year.
And also, too, I mean, it's going to be the Ranch Bernardo Inn, but you got all the golf slots filled, so they can't do anything with that. But they can still go ahead and send donations into the website there.
And the website, again, is just fightersfightfoundation.com. It's fightersfightfoundation.com.
Yeah. And then I'll be heading down right after the show to the Corvette Owners Club of San Diego, hosting the 25th Main Street America People Choice Charity Car Show. Now, this does benefit the San Diego Center for the Blind. A $1 donation will be requested of all spectators, but they got a lot of things going on down there. They got vehicles from a 1914 Ford Model T. They got Packards. They've got Mustangs, Camaros, T-Birds, lowriders, street rods, exotics. I did drive down. Gosh, a lot of fun driving down my Lamborghini down here to the radio station, driving it down there as well. But another good charity, that'll be today at the Embarcadero Marina Park North, right near Seaport Village, from 10 to 3 today. So I hope you see you there. Come on down and say hello there, because it's going to be for great charity. So, all right, phone number is 833-288-0973. That's 833-288-0973. And right now, first time this happened in a long time, all phone lines are open. No one usually got at least a couple people waiting. Oh, there's someone calling in right now. How's that for timing? So, but and again, I want to talk more about our posts and our newsletters. The other place that people can get information about us is on our Facebook page, Smart Investing. There's a group page, Smart Investing with Brent and Chase Wilsey. You'll get that stuff daily, information that we try to do every day, at least 2 posts for you about what's going on. If you miss my segment on KSI, they do on Sundays, or your segment that you do on Fox 5 on Wednesdays, we try to put those there as well, so you can catch up on that. But just great information. We really try. And when people come in, we probably see, probably 2 to 4 new people a week come in for investing with us. As our whole thing we tell people is trying to educate our investors, our clients, on the education. And I will say that through the COVID situation, when things dropped dramatically, we said out of 700 clients, we probably got, 10 calls from people that were, concerned. Because, again, we educate people. We talk about, and our slogan is, no emotions, just results. And you're going to see that coming up. Is it tonight? No, next Saturday. It's going to be in the Snapdragon Stadium.
Oh, yeah.
Yeah. No emotion, just the results. So we're advertising on the big thing there, because it's so important to be a smart investor. And that was my slogan, 40 years ago, was smart investing, because you've got to really know what you're doing and not just let the emotions control what you're doing there.
Yeah, I mean, it costs people a lot of money, and it's always the big caveat is I'm not being emotional. You're being a little emotional.
Yeah, I'm not being emotional, but I know Biden's doing a terrible job, so therefore I need to get out. Well, that's an emotional thing, because again, you got to look at the businesses, and I've often said this: I don't care who the president is, the CEOs of companies will find ways to run that business the best way they can and make money.
That's what it comes down to, is making money. And I was listening to a conference call the other day, and they're in the streaming space, and they were talking about, no, we're not just going for subscribers. Like, the market's wrong on that, essentially. Yeah. We care about free cash flow and profitability. It's like, oh, that's the type of business I like to own, is a companies that generating cash flow and making money.
That's right.
Again, it doesn't matter if Biden's president or Trump's president, they're still getting free cash flow and getting earnings.
And growing the business over time. Phone numbers here, 833-288-0973. Let's go out to San Diego and speak with Greg. Greg, you're on the Smart Investing Show with Brent and Chase. How can we help you out?
Hey guys, how you doing?
Good. How you doing?
I don't have much in investing. 401k that I have a little bit of control over, and a company retirement plan. but I've recently just dabbled with buying 1-ounce gold coins, and I noticed before the pandemic, it was in the 17, 18 range. A couple of 6 months ago, it shot up to 2,000. About a month ago, it dropped down to 1,700. And I have no understanding of it other than I just bought 2 ounces about a couple of weeks ago for the grandkids. They're 6 months old and 3 years old. It's just kind of for fun. But is it bad idea? I'm not investing that much. Probably in the next 10 years, I'll invest maybe $20,000 in coins.
It's. I don't say it's a bad idea, but it's not a good idea. I'll put it that way, because you mentioned $20,000 over the next 10 years. I think you said. Well, I would love to see that go into businesses that'll actually grow the earnings and grow their sales and grow their cash flow and so forth. But to the coins, I mean, the gold coins. Now, I don't know if they're rare gold coins, because then there is a value based on the rarity of that gold coin. But if it's just a gold coin that's only based on the value of the gold.
It's just the spot price. It's based on the spot price. But I'm not very knowledgeable. I'm a blue-collar worker with like almost no knowledge investing other than what my retirement plan does. So it's not like I'm capable of really controlling it. There's not that much money. It's an occasional, I have $4,000 extra. I'll buy a couple of coins. You know what I mean?
Yeah. And my concern is that we used to be on the gold standard years ago. That was kind of helpful because then you had inflation, the gold would go up and so forth. We are now not on a gold standard. If gold was going to be a great inflation hedge, you would probably see gold now up at least, I would say, since last year, up at least 40 to 50% because what inflation is doing, and it's virtually been flat at best. So, I mean, they look nice. They give you something tangible to give to you. I think you said your grandchildren.
I think that's why I'm getting it.
Yeah. And it
honest.
used to be back in the day when I first started that I'd say, well, go ahead and get like Disney stock. You get this nice certificate with all the characters on it, and the grandkids really like that. But you don't get stock certificates any longer. Yeah. And I know you want to give them something tangible, maybe half gold coin and a few shares of a great company.
Yeah, and one thing I look at here too. I mean, Brent kind of already talked about how it is flat. Literally, year to date, it is up 0.06%. So it's flat year to date. 1 year it's up 2.8%, which it's just crazy. I mean, because to let you know, Greg, we actually held a inflation hedge in gold in the portfolio at the beginning of the year, and we're severely disappointed with how it responded to the inflation. We knew inflation was coming, and sure enough, it was there. And gold just did not act the way that it has historically done. And the reason that I'm very skeptical of investing in gold again is when we talk about buying businesses, we talk about buying those cash flows, those assets, those earnings. You can value all of that. With gold, we always tell people it's just a piece of metal.
Yeah.
There's no way to say gold's going to go to 3,000. Well, why?
Right. Because I've read so many articles where, by 2025 it's going to be 4,500, and I don't see it anywhere near that happening. But there's so much positive written about gold.
Yeah. And I think it's
in the marketing, you know what I mean?
Yeah, I think it's an emotional thing, and you brought up a great point in the marketing. And there's always going to be somebody that is going to be pushing the positive sides of gold. There's always going to be somebody that's pushing the doom and gloom and how the stock market's going to crash 80%.
You got to have gold.
You got to have gold. You're always going to see those marketing pieces out there. And I will tell you one other thing with the grandkids is we have actually one of the girls that works in our office, her dad had a bunch of gold. It's a lot harder to sell gold than it is to sell a stock. And also too, you got to be very careful when you're selling gold because you have to go to a trustworthy source that's not going to rip you off and have a huge spread between the bid and the ask. So it's a much more complicated process of transacting that. So you got to be careful.
I've gone to these like gold vault places that when you go in, they actually buy from the mints, and some of them store gold, and they're basically spot price, and then they have a premium. And if the premium is reasonable, you can buy. If the market drops, if it's not, like I say, it's kind of the beauty of it that I'm purchasing it.
Right.
If that makes any sense.
And it does. And I don't know if you're married. And I know you're doing this for the kids. but your wife might like a gold bracelet that she can at least wear and so forth, and still have the gold.
Yes.
And you'll be like, wow, you're the best husband in the world.
Well, the two ex-wives have everything. So, and that's okay by me. That's okay by me.
And no third on the way?
I appreciate the input, guys, and the insight. Thank you so much.
Okay, Greg. Thanks for calling. Have a good one.
Bye.
Bye-bye. All right, that does open the phone line, 833-288-0973. That's 833-288-0973. And Chase, we talked about the intangible, book values and so forth. I did look up Amazon, and I just pulled it out of the hat as came to my mind, the symbol. And their price to book value is 11.1, above the industry at 5.5. Now, the price of tangible book value is 13.2, but the industry is 75.1. Now, so it looks like Amazon's not in bad shape. I mean, 13.2 is not too bad, but the industry is 75.1. That means, and they're in the internet retail industry, there are some companies in there that are way, way overpriced on the value of their intangible assets, which will probably see it right down that. And again, that's the average of 75. You got Amazon at 13.2. That means there's ones out there at 100. And if you own those internet retail companies, you probably want to say there's going to be a big write-down because sales are slowing down.
Yeah, you got to understand what industry they're in, because sometimes, too, if they – I'm just going to use a company that's maybe buying like IP rights or content, and they're bundled in there. Generally, their price to tangible book value is probably going to be not material.
Yeah. Because
those are the IPs many times an intangible asset. The other thing, too, that you talk about is the price to book versus the price to tangible book. That's how you can tell if there's a lot of intangible assets there. If there's a huge discrepancy between the price to book and the price to tangible book, there's going to be a lot of goodwill and a lot of intangible assets on that balance sheet.
Yeah, and I'll say Amazon's sitting pretty good on that one, but it is hard. And that's why when we compare our companies to the industry average, we want to compare like things. And this is set up by usually what is who's that these industries up? I think there's a couple different ones that set it up, and I forget who Stock Rover actually goes through to do it. But it's a good thing. It was I can't remember the symbols off the top of my head, but it's not at the bottom of the page here, is it? Let me just check real quick. I don't think it. No, it's not. I remember Reuters had the bottom of the page.
Yeah.
But it's just something you want to kind of compare to. We always compare apples to apples, is what we always say, and that's why it's so important. But again, if you have companies that are in the industry and you go and you see internet retail, look at the price of tangible book value. Is it really high? If it is, you need to kind of step back and say, what are they doing? Will this be written down? Have their sales slowed down? Did they buy something, 6, 12 months ago? Well, it didn't happen, but they buy a Peloton at $100 a share, and now it's at what, 10 or 15? So that's what you got to kind of look at there.
Yeah, and the hard thing, I'll tell you, when we talk to people, we are always saying you got to understand how everything works together. Because when you tell me Amazon has a 13 times price to book, that's really high. Like generally, we like to buy something around 1 to 2 times. Now, Amazon is overvalued in our opinion, but to me too, if a company can produce a lot of cash flow with little assets, I'm more okay with an expensive price to book value, right, because they're able to generate earnings and cash flow from a small subset of assets. That's not a huge deal because your equity may not be as high. But again, that's why you have to understand how all the metrics work together. People are like, give me your top 3 metrics that you look at. You can't. You have to understand the full picture. I remember it takes me back to playing football, and my college football coach, I was saying, you need to understand the big picture. You understand your job and then the whole picture there, and it all works together. It's the same thing here. You got to understand how the sales impact the earnings, which then impact the cash flow, and then where do the assets kind of fit into that, and where are the debt levels. And it's this huge, beautiful painting that all comes together.
Speaking of cash flow, Amazon trades at 41.3 times cash flow. And cash flow is very important, and you spend a lot for that cash flow. And again, it's a great company, but just still way, way overpriced. All right, let's head out to San Diego and speak with Jim. Jim, you're on the Smart Investing Show. Brent Chase, how can we help you?
Hi, Brent and Chase. I would like to hear your opinion on Molson Coors, please.
Molson Coors? Okay, you changed up on us there. Okay.
Oh, I thought that's what it was, TAP.
But we had PAP. I think it was just
you probably misunderstand
the
that.
P and the T. Yeah, I can see how that gets messed
okay.
up. It's all good.
We can do it for us. Just change gears here really quick because we tried to, as we're talking, try to put it in the symbol so that we can get to it right away. And but we'll get it up here for you. Okay, there it is. Molson Coors beverage symbol is TAP, tap. They're in the industry of beverage brewers. 5.3% float, no problem there. Institutional ownership is high, 89.4. Last reported earnings were June 30th. They do have a PE ratio of 16.9 versus 20.9. Price of sales 1.2 versus 1.7. Price to book value 0.9 versus 2. And then price of cash flow 8.3 versus 9.7, and a PEG ratio of 7.5, which is not phenomenal, but the industry is at 25.5. So compared to the industry, that's pretty good. No earnings per share growth over the past year, and I believe because they probably don't have all the numbers in since they just reported not too long ago. Sales were up 7% year over year. The industry was 11.6%. You do get a 2.7% dividend from Molson Coors. And also the payout ratio is about 43%, so that's a pretty good number there. They have increased their dividend by 19% over the past year. Look at the balance sheet, got a current ratio of 0.8 versus 0.9. Not good, but not bad yet. You don't want to see that drop much more. Debt to equity does look pretty good, though, 0.5 versus 0.7. Molson Coors does have a net profit margin of 6.9 versus 8.3. Return equity, disappointing here for the company and the industry, 5.5 versus 8.3.
Current price here for Molson Coors was $56.71. 52-week high was $60.12, and the low, that's $42.46. It's done very, very well year to date, though, up 24.1%, while the S&P 500 is still down around 9-10%. So definitely some encouraging numbers there. I will say I'm supporting the sales of Molson Coors today. I think I purchased I think I purchased like 400 Coors Lights for the tournament today. So hey, hopefully that'll reflect in their sales next quarter.
I've drank a few Molsons in my day back.
Hey, that's what we like to hear. But looking out to December 2023, we see estimated earnings per share of $4.19. Well, that would give us a target sell price of $69.55. So it's still above that current price, even with the nice run-up that we've seen so far this year. That would be what we call in our hold category, though, because it is about 23% away. So I wouldn't be a buyer of Molson Coors at these levels, but I also wouldn't be a seller. And I think, especially in potential recessions, we always talk about alcohol generally holds up quite well in recessionary environments as well.
Yeah, that's what I've heard. I kind of thought it might be in the hold category.
Yeah, so, Jim, we can't recommend buying the stock now, but go enjoy a Molson's or Coors Light. You can do that while you're waiting for the stock to fall. All righty?
Yeah, I like Coors also. Thanks. Appreciate it.
All right, Jim, thanks for calling. Bye-bye.
Bye-bye.
All right, that does open the phone line, 833-288-0973. That's 833-288-0973. And by the way, all phone lines are open, so if you call, you will get on through. Right now, let's talk to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Good. Talking about Charitable Remainder Trust this morning.
Yes. So with a charitable remainder trust, I wanted to talk about this, number one, because I'm working with somebody on it right now, but also with Chase's big charity golf tournament. I thought it'd be fitting.
Good timing.
That's right. So what a charitable remainder trust is, it's an irrevocable trust where you would put assets like a business or cash or real estate or stock or really anything like that, but you would put assets into a trust that eventually would go to a charity. But in the meantime, you would be able to receive income from those assets either for the rest of your life or for a period of time. You determine that when you set up the trust. The contribution that you put into this trust is a charitable tax deduction, so you get a deduction for that. And if you put appreciated assets into the trust, you don't have to pay any capital gains on the liquidation of those assets. The tax deduction, the calculation of it is not just the fair market value of what you put in, it's the fair market value of the asset contributed minus the net present value of the income that you would get from that asset for your life expectancy. The IRS has formulas and actuarial tables for determining that, but that's how the calculation's calculated. But so I've got an example of kind of how this would work. So let's say you have a piece of real estate. Let's say it's a rental property and it's been depreciated over, its entire useful life. So the cost basis is extremely low. The market value is high. So if you were to sell this, you could have capital gain taxes, state taxes, Medicare taxes, depreciation recapture, all kinds of taxes. So let's say a third of the sale price is going to all these various taxes. So if you sell it and pay the tax, the net proceeds that you would receive wouldn't be as much. So if that was reinvested, you would have a lower amount of income because after paying these taxes. So if we compare that to using a charitable remainder trust, well, in that case, you could take the real estate, put it into the trust, and then sell it inside of that trust. In that case, there's no capital gains taxes that you have to pay. Once the asset is sold, all of the proceeds can be fully invested in income-producing assets. You receive a tax deduction for that contribution of the assets that you put in, and now you're receiving a higher level of income for the rest of your life because you're not, you don't have to pay that huge tax up front. When you die, the remainder of that trust goes to a charity, but if this is done correctly, in many cases, the value of that tax deduction plus the increased value of that income that you would get from the rest of your life can amount to more than what you would be leaving to that charity. So as I mentioned, I'm working with somebody on doing one of these right now, and he may be listening. But in that case, what we're doing is we're using that tax deduction to then shelter some Roth conversions that we're also doing. The tax deduction happens in the year that you do it, and it can also be carried forward for a few years. So we're using that tax deduction to then allow for some Roth conversion. So it's a kind of specialized strategy, but in certain circumstances, it can make a lot of sense.
And Harrison, I think the key word there is the circumstances. And one thing that I kind of look at is that some couples don't have children. They never had children and so forth. This would make sense for them because they get to enjoy the tax benefits now and also do something good when they pass away. It will go to the charities. And sometimes I see people donate their estate to the charity. Gosh, why didn't they do a CRT? So
yeah, exactly. Get the tax deduction and get a higher level of income because you're dealing with essentially pre-taxed income as opposed to the net proceeds after selling a piece of asset.
And then one more quick question before I let you go. Also, too, you don't have to do the whole estate. You can do part of it, correct?
Oh, yeah. I mean, it's pretty flexible in how much you can do. You can choose the timing of it. You can choose how much you want to contribute. You can choose the level of income that you would receive, and all of those factors determine what that tax deduction is going to be. But all that is set up when you're creating the trust at the starting point.
Great. Well, Harrison, thank you very much. You have a great weekend, and we'll see you on Monday. You're going to be at Chase's golf tournament today, right?
Yes, we're going to be golfing. So
are you golfing?
We're going to have some of those molten cores.
Well, he's got a lot of them. All right, Harrison, have a good day. We'll see you Monday. Bye-bye.
All right, we'll see you Monday. Thanks, guys.
All righty. Okay, phone number is 833-288-0973. Let's go out to San Diego and speak with Elaine. Elaine, you're on the Smart Invest Show. Brent Chase, how can we help you out?
Yes, my question is that I have a question about this company. Is Darling Ingredients, DAR is a symbol.
Do you hold that or looking to buy that?
Buy.
You're looking to buy that? And what'd you hear about Darling Ingredients?
From the TV.
Okay. All right. Well, let's take a look at Darling Ingredients. And I like the concept of ingredients. It sounds like it's a simple business. Their symbol is DAR. They are in the packaged food industry. Only 2.2% shares on float. Institutional ownership, very high, 97.6%. We do see a PE ratio of 18.5. That is just under the industry at 20.4. That's positive. Price of sales, a little bit high, 2.3 versus 1.6. Price to tangible book value, 10.6 versus not material for the industry. And price to cash flow checks in at 16.7, just slightly above the industry at 15.8. But I love this PEG ratio, and that's what you're paying for the future growth based on your price earnings divided by growth. Only 0.3 versus 78 for the industry. So that's a nice PEG ratio there. Now, the earnings have grown by 41.6% over the past year, better than the industry growth at 25.3%. Sales up 33.9% versus 8.8%. So those are very good numbers. And the 5-year earnings per share estimated growth by the analysts, well, that's 43% versus 3.5%. So this company's looking pretty darn good here. Unfortunately, there's no dividend. They don't pay any dividend. The balance sheet, current ratio 1.6 versus 1.3. Debt to equity only 0.9 versus 1, so that's a positive. Net profit margin 12.6 versus 7.9. Return on equity is 19.8 versus 29.9. So I think it's going to come down to what we're paying for this company. Chase, what do you got there?
Just real quick, I like this business a lot. It's they actually work with one of our companies in our portfolio where they produce renewable diesel. So they actually take animal byproduct and they take used cooking oil and then they produce that renewable diesel. And the cool thing about renewable diesel is you don't know it's renewable diesel. It just functions like diesel. You can put it in a diesel car. I always thought this would be, I think, a good potential green solution is you're just using stuff that we already have as waste and producing energy. But I digress on that point. Let's take a look here at the numbers. Current price for Darling Ingredients, well, it's $77.44. 52-week high is $87.59 and 52-week low, $55.71. So up about 11.8% this year, which is a good return again against the S&P, which is down 10%. I go out to December 2023, though, for the company. I see estimated earnings per share of $6.65. That's a very nice growth from this year's $5.12 that's estimated to come, about 30% gain actually. So company is seeing very strong earnings growth. Valuations are still pretty darn good on the business. We have good estimated growth on the stock price. Balance sheet looked good as well, I believe. Yep. I like the concept. I like this business here, Lane.
And also, too, I see the estimates 90 days ago were 635, so those are increasing. I will point out that the numbers are a little bit wider. I mean, the low estimate's 545, the high 796, but that's the only negative I can see with this company. I like the concept of it. I like the price.
And I will say, too, that the renewable diesel is not the only thing that they use their feed ingredients for, but it's just something that I know they're involved in.
Yeah, I think it's definitely worth a look to invest in this company, Elaine.
Oh, great. That's great. For a long time, for long run.
Yeah, long run, unless it becomes overpriced very quickly. We've had that happen. We generally hold for a very long time frame, but I will say over my 40 years of doing this, there has been time we buy a company based on the long term. 6 months later, it hits its target sell price, and we do sell it. So that doesn't happen too often. Alrighty?
Right. Thank you so much.
Okay, Lane.
Thanks for your help.
Thanks for calling.
Bye-bye.
Bye-bye. All right, let's head out to Santee and speak with Jim. Jim, you're on the Smart Investor over at Chase. How can we help you?
Good morning. I was wanting to check on LMDX.
Okay, and do you hold that or looking to buy it?
I do hold just a few. I had kind of a flyer and wanted to see what you thought of it.
All righty. Looks like it's Lumira DX is the company name, I believe is the way you pronounce it. The symbol is
Lumidex.
Lumidex. Oh, so it's got a capital D and a little X, so it's Lumidex is how you pronounce it. Okay, and then the symbol is LMDX. They're in the industry of diagnostics and research. Only 0.3% float here. Institutional ownership, unfortunately, very low. It's 8.6. Now, I say unfortunately, that could be a positive because it means maybe more institutions can come in and buy it, or it could be that they just don't like it. We do see a PE ratio here, pretty good, 17.6 versus 44.8. Price to sales 1 versus 4.8. That's positive. Price to tangible book value 5.8. Not material for the industry, so that's not a good one for the industry, but company good for that. And no price to cash flow and no PEG ratio, unfortunately. No earnings per share growth or sales growth over the last year. Could be they're just not being reported. I do see the last reported date was 8/31. Says next report date 8/18/22. So there should have been something in between there, but yeah, we could be missing some numbers here. So be careful if you're going to invest in this company. They do not pay a dividend. Look at the balance sheet. A nice current ratio 2.9 versus 1.9. Debt to equity is on the high side. 3.1 versus 9.3, and net profit margins 5.5 versus 12.2. Return on equity 19.2 versus 15.9.
A couple of things here that stand out. Number one's the kind of wondering about the filing. I noticed there's a red flag here that says late filing. So they may have pushed back that file date, which could be of concern. So I would want to understand what the heck's going on there. Yeah. Are they trying to hide something in their accounting practices? I also do see they have a large amount of high stock-based compensation. So that's always something that can dilute the current shareholders. You got to really keep an eye on that, as it can be quite dangerous in the long term. Looking at the current price here, though, for LMDX, it's $1.68. Wow, 52-week high, $11.09, so really falling from there. 52-week low, $1.30, so year-to-date return down 81.1%. So definitely appears to be a very risky stock. I do wonder if that late SEC filing is having anything to do with that stock price movement, or if it came kind of earlier in the year with a major decline. Also not sure if they had anything to do with COVID, but I did see there was a COVID kind of testing company that just got hammered the other day because the testing is starting to pull back a little bit. Yeah. Going forward in December 2023, though, unfortunately, I see negative 60 cents is the estimate, so I can't derive a target sell price here. Definitely a speculative company rather than that value company that we're looking here for.
And Jim, this is a company that, again, you see it down, 80% or something, Chase said. This is one that it could be a great buy where you found one that's been beaten up in the SEC filings and so forth. You've got to read through those and really understand what are the problems. Are they fixable problems? Because if not, the stock's only $1.68. But, well, how low can it go? Well, if it goes down to 80 cents, well, what's the big deal? Well, you just lost 50% more of your money. So if you're going to do this, you really got to dig into deep what the problem is and can they fix it.
And the other thing, too, is that they are headquartered in the Caymans.
The
Caymans, yeah. So sometimes that has an impact on the institutional ownership. And we don't buy ADRs in the portfolio, again, American Depository Receipts, or we haven't in a long time.
Right.
So I don't know why it has that impact. I haven't looked into it because we don't have any or looked at buying any. So I don't know why the institutional ownership is always so low on the ADRs. It may have something to do with the calculation of it, but that may explain why the institutional ownership is only 8% is because it's a foreign company.
Yep. So, Jim, I'd be very cautious here. All righty?
Okay, thank you. It's a flyer. I just want to get your opinion on it.
Okay, sounds good. Have a good one. Bye-bye.
Thank you. Uh-huh.
All right, that opens the phone line, 833-288-0973. That's 833-288-0973. Let's go to San Diego and speak with Jerry. Jerry, you're on the Smart Investor over on Chase. How can we help you?
Oh, yeah, I wanted to see what you thought on AMD. I own some now, and I was just looking to see if it was a good time to add on at all.
Okay. How much are you up or down in it? Where do you stand now?
I average in about 85.
Okay. All right.
What is it? 85.
Okay. All right. Let's AMD, that's a symbol. The company is Advanced Micro Devices. They're in the semiconductor industry. Not much float here, 2.2, 68.6% institutional ownership. PE ratio, unfortunately, very high, 42.9 versus 19.7. Price of sales, 6.4 versus 4.8. Price of book value looks good, though, 3 versus 4.1. And price of tangible book value, 37.8 versus over 100 for the industry. But a big, again, here's a company with a lot of intangible assets. Again, price of book value of 3, price of tangible book value of 37.8. So it could be some write-offs on those intangibles. Price of cash flow is 37.5 versus 13.7. PEG ratio is 0.9 versus 4.4. That's a very good PEG ratio. Now, I'm surprised on this. We do see earnings down 16.7% for AMD. The industry is up 40.8% for the 1 year on the earnings. Sales did climb by 61.7%, well above the industry at 9.8%. The analysts like this over the next 5 years. They say earnings should grow at 26.8%, well above the industry at 16.8%. They do not pay a dividend. The balance sheet, current ratio 2.4 versus 3.1. Debt to equity only 0.1 versus 0.6. And then net profit margin 14.5, not nearly as good as the industry at 24.9. And return on equity, also a disappointment here, 5.7 versus 26.6. Chase, what do you got?
Yeah, so number one, I just wanted to point out, like AMD, they've done a great job competing against Intel.
Yes.
I mean, that's one reason the stock has performed so well is they've really done a great job stealing market share back from Intel. I know they've competed for years, and I think they're kind of
doing this in the 90s.
Yeah.
Back in the 90s, they're doing the same thing, yeah.
And it seems like AMD's kind of got that. They don't have the upper hand because Intel still has more market share,
Right.
but they've really been gaining market share compared to Intel. It always concerns me a little bit with AMD is if they start to lose back some of that market share because they have been so expensive, it could hit the stock. And you'll kind of see what I mean when I look at the numbers going forward. But I do want to start with the current price on AMD. It's $100.83. So it sounds like you're up a little bit there, Jerry. 52-week high, $164.46. And the low, well, that's $71.60. Year to date, I didn't know AMD was struggling this much, down about 30%, as it's been hit quite hard with many of the other semiconductors as well. Going forward, though, to December 2023, I see estimated earnings per share of $4.91. It gives us a target sell price of just $81.51. So it's expensive, and that's what I'm talking about here with Intel. If Intel can start to steal back some of the market share that they lost, AMD starts to have a slowdown in sales. They're already overpriced. That could hit AMD even more as it's just expensive at this point.
And, I did go to the balance sheet and looked at, for the recent quarter in June, they had in goodwill $24 billion. And then in intangible assets, they had $26 billion. And this is, and I'm checking the numbers, make sure I'm doing this right. Going back to June 2020, they only had $289 million.
Didn't they buy Xilinx?
I think they did.
That's where it all came from.
Okay, yep. So that's a big thing. Now, again, this could be a problem for them. We talk about these write-downs because that's a lot of intangible assets and goodwill. So you could see an impairment down the road. So I'd be a little bit careful here. And I know everybody loves AMD. It's, again, taking market share. It's doing everything. It's working on all cylinders here. But if they start skipping or something happens here, you can see that stock fall more than, what do you say it's down, year-to-date 29% or something. Yeah. So I'd be careful. It is a great business, but it's a very expensive business with perhaps some things underneath that you won't see on the intangible assets.
And especially if they bought Xilinx at a peak, it seems like they bought it at a very expensive time. That is a prime candidate for a write-down in future years if it doesn't come back.
Yeah. So I would be careful here, Jerry. All righty?
Okay. That sounds great. Hey, thanks a lot. I really appreciate your analysis.
You're welcome. Have a good one. Thanks for calling. Bye-bye.
You betcha. Bye.
I was going to say that opens on the phone line, but gosh, it's already about 3 minutes left till the end of the show. So, and I was shocked on that on AMD that they had that much goodwill. But you're right.
I forgot that. That was a big purchase that they made.
And I wonder if they bought. See, one thing too that some companies they might do a big purchase like that, or they could have done 10 small purchases over the last 2-3 years, which could hurt just as much if you had to write all those down.
Yeah, and I feel more comfortable with the company that the intangibles or the goodwill happened like 10 years ago. Because at that point, it's far more unlikely that you're going to have a huge major write-down. As long as that business is integrated well under the company, it's I think, a lower risk. But when you buy a Xilinx-type business, and again, I think they could have overpaid for it as everybody was hot on semiconductors at that point. And, if that doesn't pan out the way that they plan, that's when you get that write-down.
What's a shocker is that they're down more than Intel is year to date. Intel's down 28. I think you said they're down 29.
Yeah. Well, it's because they were trading at very expensive valuations, and Intel was trading at 10 times.
And Intel does pay that nice dividend. So, and again, we do talk about, and this is 2022. I remember in the 90s when I was investing, AMD would be ahead, not for a few months, but for years, then Intel. And don't think Intel's just folded up their tent and gone home. No, they're working very hard to get that market share back. And I think the numbers are somewhere around, I think Intel has around 72%. I think AMD has about 28%, I think, of the. So they could take some of that back, or AMD could continue to do that, but it's just a very expensive company. And be careful those intangible assets, because they can come back and people, and you'll hear the things, it doesn't matter, it's not real cash and so forth. But that means, why did you buy, you said Xilinx? It's such
I believe it was Xilinx. There was a couple acquisitions going on at that time.
Well, whatever the company was, why'd you overpay for it? I mean, your management, didn't you realize that, we're paying 100 times earnings for this company, 100 times cash flow it may be. Why'd you make such a poor decision buying that company now.
I always talk about these growth companies. One reason I really don't like growth investing is you start to reach for growth. Once you hit a point, you're trading at 30, 40 times earnings, and you're like, well, our earnings are now only growing at 12%. We need to find growth. Well, you can't just go ask somebody to buy your product. That's not going to help grow it. So you try and reach for growth, that's always a big concern for me. And a lot of times people are like, oh, well, they're going to grow at 20, 30% each year. And it's like, at some point, it can't happen.
Not going to happen. Well, there's a closing bell. Thank you for listening to Smart Investing Show. It is for information purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And visit our website. A lot more information there, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information, along with investment tips, go to our Facebook page, Smart Investing with Brent and Chase Wilsey. Thanks for listening to Smart Investing Show. We'll be back next week, and enjoy your weekend, and hope to see you down at Embarcadero Park and at the Richmond Auto Inn for Chase. All right.
And may I say,